What on earth is going on? Bolivia is literally printing money with gold. The United States is piling up debt 5 years ahead of schedule. Subprime borrowers are defaulting faster than during the financial crisis. Retail investors are shoveling billions into stocks at record valuations, while the so-called smart money quietly sells. And world leaders meet for peace talks, only to be accused of failure simply because they didn't escalate a war. And here's the crazy part. It's all happening at once. And by the end of this episode, you'll have some cracking talking points for your next dinner party, like how the Federal Reserve's main liquidity buffer has collapsed by 97%, or how sanctions have made Putin more popular while Europe suffers, or how one man on a Soviet submarine once saved the world from nuclear annihilation by refusing to fire a torpedo. Let's begin in South America, where Bolivia's central bank has just shown the world why gold still matters. It has bought 24 tons of local gold, monetized 44 tons, and held another 19 tons overseas, raising around $3 billion. And that's not just diversification, that's smart planning for a new world order. When fiat credit runs thin and dollars are harder to access, gold still works. It's not theoretical, it's just practical. And central banks everywhere have been doing the same, buying gold at the fastest pace in half a century. Meanwhile, in the United States, the cracks are spreading through household credit. Subprime auto loan delinquencies are now above 5%, the highest level on record and worse than during the global financial crisis. They have doubled in the past 4 years. This is what the supposedly resilient consumer really looks like. Families unable to keep up with their car payments in an economy where owning a car is a basic necessity. And just as households falter, all eyes are on Jerome Powell at Jackson Hole. He faces 3 competing stories of the US economy. Markets believe demand is weakening, pointing to downward jobs revisions and weaker spending, and so they expect rate cuts in September. The Trump administration insists the economy is strong, just like the 1990s, and says lower rates will unleash productivity gains from tax cuts and deregulation. And mainstream economists argue it's stagflation, weak supply, tariffs driving up costs, migration curbs tightening the labour markets, inflation still bubbling. Powell can't satisfy all 3. And cut too soon, inflation will take off again. Hold too long, and a recession takes root. Either way, he's boxed in between the markets, the White House, and economic reality. Yet retail investors don't seem to care. They've poured nearly $190 billion into equity ETFs this year. At the same time, institutions have sold about $40 billion. It's one of the widest gaps in history. Ordinary investors are buying at the top, while professionals quietly exit. History is not kind to that pattern. Now, Howard Marks, the man who called the dot-com bust, the Great Recession, and the COVID panic, is warning again. His red flags are obvious. Market concentration is extreme. Just 7 tech giants now account for a third of the S&P 500, double their share 5 years ago. Credit markets are priced for perfection, lending at spreads so narrow they can assume nothing can go wrong. And the Federal Reserve is trapped between fighting inflation and avoiding recession. So Marx's conclusion is blunt. A downturn is sooner than otherwise. Valuations only reinforce the point. The S&P 500 now trades at 5.3 times book value, and that is higher than any previous bubble. History shows that when valuations reach these extremes, long-term returns collapse and corrections are brutal. Nvidia alone now makes up more than 8% of the entire index. Every dollar that flows into passive ETFs pushes it higher, reinforcing the loop until momentum breaks. And behind the market froth is a quieter but more dangerous shift in financial plumbing. The Fed Reserve's repo facility. Once the shock absorber of the system, it has collapsed from $2.5 trillion to just $57 billion. A 97% drop in 2 years. That matters because the RRP cushioned the impact of the quantitative tightening. With it nearly empty, further balance sheet shrinkage hits bank reserves directly, the core buffer of the financial system. It's like removing the suspension from your car, every bump hits harder. And for now, the cash has gone into treasury bills and bank deposits, loosening conditions. But if stress reappears, be it a debt ceiling crisis, banking wobble, credit crunch, The absence of that buffer could make the shocks far worse. Hovering over all of this is the national debt. The United States just passed $37 trillion, a milestone the Congressional Budget Office said wouldn't be reached until after 2030. We're 5 years early. By 2035, the figure is expected to exceed $52 trillion. Trump's deficit bills, extended tax cuts, and rising defense spending have locked in structural deficits. Now, Steve Hanke, the economist, calls tariffs a Dumbo tax, and he may well be right. They are a hidden sales tax on Americans. Canada has cut American booze imports by 60% in retaliation. Sanctions are no better. They made Putin more popular at home, weakened Europe's competitiveness, and undermined trust in global finance by freezing sovereign reserves. You don't need to be a gold bug to see that this is reckless. And here's where the bigger picture comes in. For centuries, the world's reserve currency was tethered to precious metals. The dollar is the first truly global currency that exists only on trust, untethered since 1971 from any anchor. That trust is held because America was powerful enough to enforce rules and wealthy enough to back its promises and credible enough to offer stability. But today, the canary in the gold mine is singing loudly. The gold price is not just rising because of inflation or safe haven demand. It's rising because the foundations of the dollar itself are eroding. Sanctions have weaponized the system. Tariffs have undermined the trade, and the US has walked away from multilateralism and even shown ambivalence to its role as keeper of the peace. Now, emerging market central banks are diversifying into gold, not because they have a better alternative, but because trust in the dollar is fading. The euro is fragmented, and China doesn't want the obligations of a true reserve currency. And the BRICS initiative, well, that seems to have collapsed before it even began. There is no successor. So the world runs back to gold. History shows transitions are messy. It took decades for sterling to give way to the dollar, and we may now be at the start of a similarly slow, uncertain shift to a multipolar system. And during that period, gold will remain what it has always been. Nobody's liability, nobody else's promise, the ultimate barometer of stress in the system. If the financial picture looks reckless, the geopolitical one, well, quite frankly, just looks insane. Trump and Putin just met in Alaska for peace talks, and the media immediately called it a failure because they didn't escalate the war. At the Ron Paul Institute, Jeffrey Sachs made the very feasible point that wars like Ukraine and Gaza could be ended tomorrow if Washington wanted it to. The problem is not about complexity, it's about will. And Eisenhower warned in 1961 about the unwarranted influence of the military industrial complex, and 6 decades later, it still dictates policy. Since Kennedy tried to defy it and was assassinated months after signing a peace treaty, no US president has stood against it. Sachs argues that leaders are either afraid, bought, or complicit, which is why the doomsday clock now sits at just 89 seconds to midnight, closer than at any point in history. So, what ties all of this together? Illusion. In economics, we are told that debt is growth, bubbles are sustainable, and defaults don't matter. In geopolitics, we are told that peace is failure, war is normal, and provocation is policy. Both systems survive on illusion until reality intrudes. So here are the points worth remembering. Bolivia monetized 44 tons of gold for $3 billion, proving fiat can fail, but gold doesn't. Subprime auto delinquencies are worse than in 2008. Powell faces an impossible stagflation dilemma at Jackson Hole. The Fed's reverse repo buffer has collapsed by 97%, leaving the system flying without a safety net. The US debt is $37 trillion, 5 years ahead of schedule. Tariffs are a hidden tax on Americans, with booze exports to Canada down 60%. Sanctions have made Putin more popular and Europe weaker. The top 7 US stocks now equal 1/3 of the S&P 500. The doomsday clock is 89 seconds to midnight, and Vasily Arkhipov, a forgotten Russian submarine officer, once saved the world by refusing to fire a nuclear torpedo. In a world where the financial system runs on denial and foreign policy runs on provocation, there is little reason to trust the official line. Central banks know this, which is why they are hoarding gold, and individuals should learn the same lesson. Gold and silver are the assets of truth. They don't inflate away, they don't default, and they don't start wars. When everything else looks insane, that is exactly why you hold them. And if you're getting worried about the doomsday clock or any of the other stuff that we've talked about in this show, why not head for the exit and download the exit plan now? Links below.